The LIBOR swap rate hit a historic low. What does it mean for you, your borrowers, and the HECM industry at large? To find out, join us for our exclusive interview with Dan Hultquist. Happy Memorial Day. What do central banks do to bolster a struggling economy? Two of their most common tools are to slash interest rates or increase quantitative easing. And today's buzz in the financial markets is the federal funds rate, which is now hovering barely over 0% at just 0.25%. And that impacts the liquidity for banks and access to credit, but it has nothing to do with the direct interest rates that are charged for the federally insured reverse mortgage. So to bring us up to date on the impact of the most recent LIBOR rate is the man who closely follows such developments, the author of Understanding Reverse, Dan Hultquist. So what in the world happened last week with the LIBOR?
Yeah, this has been a crazy week. Just to give you some background information, HUD requires us to rely on a figure called the 10-year swap rate to determine how much we can offer HECM borrowers. They don't want to use short-term rates. They want to use long-term rates to determine how much we're going to give someone initially. And after February 27th, it appeared the entire swap market was effectively dead. I mean, no heartbeat at all, right? The swap market was completely dead.
Right.
And so we've actually been frozen at 1.22% for 56 consecutive business days. That's 12 consecutive weeks. So the swap market was basically non-existent. So we just carried over 1.22 every week. Now, a lot of people complained about that, but 1.22 was a record low. So if you're going to be frozen at a rate, that's not a bad rate, but we looked at the equivalent on the Treasury side. The 10-year CMT was sitting at like 0.6 or 0.7. And so it's a little frustrating for us that we want swap rates to be lower so that we can give borrowers a little extra money and have a little more flexibility in our pricing. So what happened this past week is we actually saw a couple swap rates posted. We saw 0.68 come over and 0.696. And so technically it's thawed out. It's not frozen anymore.
And this is, why was it frozen so long? So I noticed the start date wasn't when the global economic shutdown as a result of the coronavirus began. So why 56 days? Why such a long freeze?
Yeah, it's interesting. There's a lot of things at play right now in the swap markets. And basically, when there's not enough trades, the Intercontinental Exchange, that's ICE, they won't publish rates. And the reason for that is because they don't want large financial institutions to have so much control over a posted rate. They don't want, some international bank to come in and make a bunch of trades and be able to influence the posted rates. And that's how the LIBOR initially got into trouble with manipulation several years ago. But historically, it hasn't been a problem. There's been enough activity, enough liquidity in the swap markets. But right now, large financial institutions are not really that inclined to be exchanging long-term maturities, especially when it's based on an index that's going away, right? The LIBOR is going to go away at the end of 2021.
So has that reduced the participants in the LIBOR trades? For 10 years is a big commitment on a swap.
Right. Those maturities we saw, they kind of went away. Last week, or the previous week, we saw a little bit of action on the 1 year and 2 year LIBOR swaps. But of course, we use the 10. We have to have the 10. So, this couldn't come at a better time, right?
Well, we've got some big changes.
Really good for us right now.
So why is the timing so good today? Because we've got the world economic upheaval as a result of the quarantine and economic shutdown. Ironically, it seems our industry is picking up, but what's going on specifically that the LIBOR could really benefit us? And what trends are you seeing that concern you?
Yeah, one of the trends that we've seen is 99%. In fact, the data I'm showing right now for March endorsements is HECMs right now are 99.17% ARMs. So that means that over 99% of the business right now is impacted by this rate change, at least on the HECM side, not proprietaries. But on the HECM side, 99% are impacted by rates, by short-term and long-term rates. Another reason why this is really key right now is that you've got 5 million homeowners in forbearance right now. That's ridiculous, and it's growing every day. A lot of them are great candidates for reverse mortgages. They're just not aware that this is maybe a better option for them.
So is forbearance a good thing, or are there some pitfalls that the consumer or homeowner should be aware of?
Yeah, from my perspective, forbearance is a very, very bad thing. What these homeowners really want is they want deferment, which is something completely different. Now, according to the CARES Act, forbearance could turn into deferment, in 2021, but these borrowers are basically just kicking the can down the road a little bit, 180 days or even 360 days down the road. But now they've got to make payments on this, and it might be unsustainable.
So that back balance is going to be due in whatever the forbearance period is. So let's say I have a 6-month forbearance. Are you telling me that I could owe $18,000 in back mortgage principal and interest?
Well, the rules for this are evolving pretty much daily right now. Initially, it looked like they were going to owe a balloon payment, which is very scary, okay, or at least an aggressive payment plan. We don't know exactly how this is going to pan out, but from my perspective, what borrowers really want is they want deferment, which is what we do. We do that on a daily basis. If you're in the reverse mortgage business, you're in the deferment business. We actually allow people the flexibility to defer payments until the loan matures at a later date, usually when they pass away or when they sell the home. One of the things I wanted to mention about forbearance is take that 5 million people, nearly 5 million people right now in forbearance. If only 1% of those, if my math is correct, 1% of those are seniors with significant equity, you're talking about 50,000 applications could have been taken in April alone. So the market right now for reverse mortgage is exploding. There's another issue at stake right now, too, is that HELOCs are going away.
Absolutely.
And you're seeing that the major banks don't want them. In addition, you've got Fannie and Freddie that have said, we really don't want your cash outs either. So HELOCs, cash out refinances, that's generally how someone with equity is going to access some of that equity. HELOCs because they're cheap, and cash out refinances if you have the ability to repay. But unless you have a really high credit score and a ton of reserves, you might not get that cash out refinance. The reverse mortgage is actually a better option than either of them if you're 62 and older.
So it's a good time to be 62 and older indeed. So let's talk about one thing that we've seen develop, because we've heard news in the last couple of months about the secondary markets. With such a low base index, and for our viewers that are not familiar with this, you have the base interest rates, or the index, which is the LIBOR, which is at 0.68 or 0.69, and then we add a lender margin. How do you see the interest above that lenders charge to ensure they're profitable being impacted by this low rate? Are there benefits, downsides?
Well, obviously the investors want a spread above whatever the index rate is. And there's not a direct correlation between a drop in long-term rates and a drop in the borrower's actual interest rate. But what you might find is that their closing costs go down. So what we're going to see, at least in the short run now, is that loan originators might have the ability to offer a slightly higher margin and offer some lender credits, but still give them the most money.
So I've looked at the FHA single family production report, monitor that each month, and the most recent data in March has about 18% of all HECM transactions, or the federally insured reverse mortgage, are refinances. Do you see that trend continuing or even increasing with this recent LIBOR change?
Well, we have seen that trend go up, and I'm seeing the same data that you're saying is approximately about 18% for March and rising a little bit. I hope that's not the case. We offer a solution right now for those who maybe haven't missed installment debt payments or unsecured debt payments. As long as we can get them through financial assessment, before some of those troubles, we have a huge market of people who really need our services.
So what would you suggest to our viewers who are the originators, the boots on the ground out there in the field today? Well, maybe not so much in the field, but working remotely with the homeowner. What advice could you give?
Well, I would definitely revisit some of those loans that maybe fell through over the last year. People might not have gotten the principal that they wanted in their initial quote. Go ahead and quote them some additional figures. I mean, this is very attractive right now, that we can get to that floor rate very easily and offer them maximum principal limits.
Excellent. And one thing I've noticed is that that pie chart that we looked at with the product mix is drastic. If you think back to almost 10 years ago, that pie chart was completely opposite. It was the inverse. We had the vast majority being fixed. Now it's 90+% are adjustable. Do you have any concerns about our present product mix between fixed and adjustable?
Yeah, and I think you're going to see that change over the next month or two. We find that the rates on the fixed rate HECMs are coming down a little bit. The pricing's improving a little bit. It's just we went through a period of time where you had the ARMs were offering so much more money. Mm-hmm. But we also need to realize the fixed rate HECM doesn't always leave money on the table. In some cases, you might want to set them up with a voluntary life expectancy set aside to capture some of that money that we can't give to the borrower on the fixed rate product. A lot of loan originators say, well, I'm not going to promote the fixed because it leaves 40% on the table for many borrowers. Consider at least taking a look at a voluntary life expectancy set aside and see how it prices out.
And so if they do that, do they get access to that money later then?
No, none of that money can actually go to the borrower. That's part of the problem with a closed-end loan like a fixed rate HECM. The money from the LISA cannot go to the borrower, so you can't have a partially funded life expectancy set aside. But if it's fully funded, that set aside amount can go to the taxing authority or to the insurance agency. And ultimately what you're doing is you're assisting the borrower with cash flow.
So you're almost really creating a prepayment account.
Exactly.
Well, that's a beautiful thing. Well, Dan, thank you so much for joining us. And folks, if you'd like more information, we got Dan's contact information at Understanding Reverse. And I would encourage our viewers, by the way, great job on your update. Dan's book, Understanding Reverse, is not only available on print, but I'm a huge Audible fan. I listen to it every day when I'm out exercising. And so put your earbuds in and learn more about the reverse mortgage, even if you've been in the business for 10 years. So Dan, thank you so much. And folks, if you'd like to share this video with other reverse mortgage professionals, you can do that by using the social media links on this page. If you're on YouTube, be sure to subscribe. That way you never miss an upcoming episode. Thank you for joining us, and we'll see you here next week for more reverse mortgage news, commentary, and analysis.